All right, welcome everyone to our student loan management webinar. We're going to be covering a lot of information, hopefully within an hour. We may run a little bit over because student loans are complicated. My name is Andrea Pellegrini, and I run the Student Money Management Center out of University Bursar for the entire University of Illinois system. And I am joined by my colleague, Nikki. Nikki, do you want to introduce yourself and your new role?
Yeah, so my name is Nikki Jancola Shanks, and for this webinar, I'm sort of two people because I just recently switched over from the Illinois Department of Financial and Professional Regulation to the Lieutenant Governor's office as their policy director. So I'm dual representing today.
And we very much appreciate it, Nikki. Nikki has a lot of expertise in student loans, so we are going to leverage that while we can. All right, so collectively, the Get Savvy webinar team represents organizations across the state of Illinois, which rest on the ancestral lands of multiple Native nations, including the Peoria, Kaskaskia, Piankashaw, Wea, Miami, Mascoutin, Ottawa, Sauk, Meskwaki, Kickapoo, Potawatomi, and Ojibwe and Chickasha nations. And we would like to know what state and or county you are logging in from today. Like we said, we have representatives across the state of Illinois, but also sometimes across the nation. But if you can put in the chat so we can both test that you know where the chat is and can use it and are comfortable with it and get a better idea of who is joining us, that will help us out. So we got Cook County, Champaign County, DeKalb. All right. Macomb, if you don't know where the chat is, if you hover over the bottom or top of your Zoom window or screen, there should be a black bar that pops up and you should be able to click on the chat icon or open it with the three little white dots and then open the chat icon. And you can ask us questions in the chat, and my colleague Suhas will be sharing information in the chat. Suhas, if you can share the link to today's webinar slides again, that would be fabulous because I think there are a few people that joined us a little bit late. All right, so another thing that we're going to do is we're going to attempt to launch a poll, if I can find where they are, and get a little more information about who is joining us so that our colleagues in Illinois Extension can maintain funding for doing statewide educational outreach. So this helps them to maintain their funding and helps us have other people that can contribute to financial education across the state of Illinois. So I'll leave that up for a second. All right, thank you for those of you that are able to contribute. We have a lot of different age ranges here, students and full-time employees, as well as retired folks. A lot of women online with us today. Good diversity going on. All right, I'm going to end the poll. You can see if you want to check out the results and see who else is joining us. I'm going to stop sharing that since we have so much to cover today. And if you still see the window up, you can just exit out of it. So here are our learning objectives today. We're going to be addressing a lot of different things throughout the webinar. We're going to talk about some common myths and facts surrounding student loans. We're going to identify the types of loans. We also want you to be able to identify how much you owe and who you have to pay, who your servicers are. We want to kind of go over the methods of managing student loans, regardless of where you are in the student loan management process. And we also want to give you some tools to create a plan for managing student loans yourself. We do have to put this disclaimer out that we won't be covering all aspects of all loans in detail. There's too much to cover. So if you have a question about your student loans specifically, you can contact your school, your loan servicer, or the federal student aid. You can also look up information as it changes because information specifically about federal student loans changes very frequently. You can check the website, but what is discussed today is current as of April 3rd, 2024. I was making adjustments to all our slides and the stuff we're sharing in the chat right up until we started recording. So, all right, so this slide kind of gives you a basic overview of the student loan management process. You apply either through the FAFSA or for federal loans or directly with lenders for private loans. The loan is dispersed, but you first have to accept the loans and complete entrance counseling and assign a master promissory note for federal loans. There'll be other requirements for disbursement for private loans or institutional loans. And while you're in school, at least part-time, all federal loans will be in deferment, but you may get new loans added each term or semester, which makes monitoring kind of your balance pretty important. If you drop below part-time, withdraw or graduate, your loans will start needing to be repaid. Obviously, you'll be in repayment. There'll be things like tax forms and repayment plans and paperwork and other things to keep track of. And then the end is having things paid off. Right? And there's a few different ways that that can happen. I was going to try to launch another poll to see where you are in the loan management process. It should be popping up. Are you applying? Are you have things been dispersed? Are you in school and deferment? Are you leaving school soon? Are you in repayment? Where are you most close to? What are you thinking about as you're listening to this webinar today? A lot of people in repayment, a lot of people applying. It looks like most people are applying or in repayment. So I'm going to go ahead and end the poll. Like I said, we're going to move fast through today's stuff. So you can see most people are in repayment, but there are a few applying to student loans. All right, so you can exit out of that if it didn't exit out automatically. And I'm going to hand it over to Nikki to talk about the myths or facts related to student loans.
Hello. All right. So particularly, I'd say in the past 3 years with everything around COVID and the pandemic as well, there's been a lot of different things in the ether about student loans. So let's go through some of the ones that Andrew and I have heard. So in the chat, you guys can either put myth or fact. The first one is, if you don't graduate, you don't have to repay your federal student loans. You guys think that's a myth or a fact? All right, good job. Most you are saying myth. That is true. It is a myth that you don't have to repay loans if you don't graduate. No matter what type of loan, federal, private, or institutional, they all have to be repaid regardless of your degree status. All right. Myth or fact, it's easy to get your student loans discharged in bankruptcy. All right, I see some myth. Yeah, so if you are going to count on any sort of declaring bankruptcy to handle your student loans, that is not a good plan. It is possible to discharge student plans, but it is not at all easy and does not work for the vast majority of people, and you should not rely on that. All right. Income-driven repayment plans are always the best option. Myth or fact? Seems like myth, some myths. Yes, so income-driven repayment may not be best for everyone. It can definitely be helpful for many people, but it's not exact for everybody. So there is a student loan simulator on the federal student aid website that can help show you different repayment plans. If you are on an income-driven repayment plan, your remaining loan balance could be forgiven after 20 to 25 years of payments. Is that a myth or a fact? Looks like a couple myths, a couple facts.
This one didn't
Let's
come in as
see.
quickly. This one's confusing.
Debatable fact. All right. See here. All right. It is actually a fact. Income-driven repayment does allow for forgiveness. It really depends on which IDR, income-driven repayment plan, you're on. It could be if you are on the SAVE plan, if your initial amount borrowed was less than $12,000, it could be 10 years, 20 for undergrad, 25 for grad or professional grad. So depending on what type of repayment plan you have, dictates the amount for the length of time for forgiveness regarding your student loans while using an income-driven repayment plan. And we're going to talk a little bit more about those, but you could see in the graph that it just depends on which payment plan you have.
And just to really emphasize, under all of these income-driven repayment cancellation options or forgiveness options, the remaining balance is what's forgiven, not the initial balance borrowed. All right, so let's talk about keeping student loans organized based on your situation, based on where you are in the loan management process. So there's a few things. Oh no. I'm all kinds of disorganized today, but let's talk about how to get organized. Let's get back on track. So to start off, especially if you're going to be graduating next month, you will want to ask yourself some guiding questions. How much do I owe? What types of loans do I have? Who are my loan servicers? These are kind of the three guiding questions to get you organized, both if you're graduating soon or regardless of where you are in the process. So one thing that you're going to want to do to get some of this information is gather your student loan information. There are several different sources. You can go to studentaid.gov for federal loans, log in with your FSA ID and password. You could go to your school for any institutional or campus-based loans. If you have private loans and you don't know who your lender is or your servicer is, then you can go to annualcreditreport.com and see if it's been reported to the credit bureaus. And the things that you want to know or pay attention to are your student loan balances, what the interest rates are, and who the loan servicers are, which can change whether you have federal loans or private loans or even institutional loans. Sometimes the servicers can change. So you can think of the types of loans as going into three main categories or buckets when it comes to repayment options. There's federal, institutional, or private loans. Direct loans are the only type of federal loans available that are still being dispersed, but they come in a few different flavors. So there's direct subsidized, which is for undergraduate students with financial need. Direct unsubsidized, which is for either undergraduate or graduate students without financial need. Unsubsidized starts accruing interest immediately after it's dispersed, where subsidized, the government pays on your behalf while you're in school, at least part-time. Then there's Direct Plus, which could be for either graduate students or parents of undergraduate students, and those are based on credit. Or Direct Consolidation, which allows you to combine multiple different types of federal loans. Like maybe you had a federal family education loan that's commonly called FFEL. It's retired now, but there's a lot of borrowers that still have FFEL loans. And then maybe you went back to school and you got a direct unsubsidized loan and you want to now combine them to qualify for different repayment options or simplify the management of your loans. And then just to kind of highlight, the institutional loans are dispersed through your school. There have been a few unique campus-based federal loans that fall under the institutional loan bucket, but are actually federally seeded loans. So you have access to federal repayment options. So these include the now retired Perkins Loan Program and the Health Professions Loan. Those are two types of institutional loans that have access to federal repayment options because they're kind of unique, but they're still typically serviced by the schools that distribute them. And then there are private loans, and the repayment and qualifications for those vary a lot by lender. So that's just something to keep in mind, right? All right, so we have another poll. We like to try to make this interactive, and it helps us better kind of modify what we're talking about. So let's see if I can get this one launched. All right, what kind of student loans do you have? It should be launched on the screen. Do you have only federal, only private, only institutional, maybe a mix, or maybe you're not sure of what you have going on? And that's why you're here, to learn how you find out, right? So it looks like a lot of people have a mix. A lot of people have only federal. There's only 26% of you that have participated. So I'll wait a little bit longer. We're doing better on time than I anticipated. All right, I'm going to end the poll so you can kind of see. Most people have only federal loans. Some people have a mix and some aren't sure. And that's okay. That's why you're here. It's always good to learn. So I'm going to stop sharing. You can exit out of that if it's still up there. So we go into a deep dive on the different types of loans available in our 8th student loan update webinar. Nikki and I did a whole series of monthly webinars between July 2023 and February of 2024 on different topics. So that one we focused explicitly on different types of loans and how to manage them. All right, so let's say if you're seeking a loan either through the FAFSA application or a private lender, obviously you want to complete the FAFSA first. There's a lot of scholarships and even some private lenders that require you to complete the FAFSA before they'll process your applications. You also want to look at your credit history, like through annualcreditreport.com. You want to talk to any potential co-signers, especially if you don't have much credit. Maybe you're younger, maybe you have poor credit. So you might be required, especially if you're seeking a private loan, to have a co-signer. And what this means is that the co-signer is equally responsible for repaying the debt. So not everybody's going to want to do that. So that's why you got to ask first. And then you want to make sure to apply and compare private education loans in a short time frame so it limits the impact on your credit scores or credit worthiness. So do it in a few days or maybe like a 5 to 7 day period. So it looks like it's one hard inquiry on your credit report instead of multiple if you applied like once a month over a 5-month period. All right, so if you're currently a borrower in school, you want to maintain records of what you're offered, what you accept, as well as what is dispersed. You want to cancel any amount you don't need in the same academic year, or ideally the same term that it's dispersed, to reduce the cost of the origination fees. You don't want to pay your lender directly or your servicer directly for a large chunk of a loan that you didn't end up needing if you can cancel it, since you'll pay less with the origination fee being diminished a little bit. So if you go to any of the universities in the University of Illinois system, once a loan is canceled, you return the money through your student account, and financial aid will send the canceled amount back to the Department of Education on your behalf. So that lowers the origination fee that you have to pay. And then obviously you want to maintain records of all your loan servicers and balances. You want to do that regularly because loan servicers change all the time. And then you also want to understand some of the pros and cons of making payments on unsubsidized loans as the interest accrues while you're in school. You can save money doing that, but it really depends on the amount you borrow and whether or not you're able to actually work while you're in school to generate income that can be paid towards interest accrual. All right, so if you're getting ready to leave school or drop below part-time or graduate, you want to update your contact info in the FSA dashboard, know your servicers, know what your balances are, obviously, understand your repayment options, complete exit counseling for federal loans. This may be a requirement for some institutions to receive your diploma. I don't think any of our schools in the University of Illinois system currently do that, but they have in the past. So, and then you also want to know when your grace period ends. All right, so finally, if you are currently in repayment, you want to maintain records of your payments, even if you signed up for automatic payments through ACH. You want to understand the requirements if you're seeking loan forgiveness, and there's a few different types of loan forgiveness, which we'll go over a little bit later. You will also want to consider applying for deferment or forbearance if you experience challenges making payments. So this doesn't impact your credit worthiness later or impact your access to student loan repayment options in the future. And then you also want to know your rights as a borrower so you can report any mistreatment or fraud to the proper authorities. All right, I'm going to hand it back over to Nikki to talk about the grace period.
Hello. All right. So we're going to kind of talk now about student loan repayment when it's time to actually start paying those loans. All right. So first, which Andrew just mentioned, is your grace period. And so this is in context of only the federal student loans. For private student loans, you'd have to talk to your individual servicer, because private student loans, individual servicers have their own policies. But for federal student loans, after you graduate, leave school, or drop below half-time enrollment, the grace period refers to the time you have before you are required to begin repayment on student loans. So for example, let's say you graduate in June. Yes, thank you. The typical grace periods, right? So usually it's 6 months. So if you graduate in June, you may not have to start paying until December. The federal or federal Perkins loans, which are no longer given out, like that type of loan, federal loan is it's all direct loans. However, we may have people on here who have loans from previous, and they may have federal Perkins loans. And in that case, that you had a little bit longer grace period. Okay, so this graph kind of shows what your different repayment options are. There are 8 different repayment plans for federal loans. We actually do a deep dive on this in one of our other student loan little mini updates as well. So I'm going to quickly kind of talk about them. So there's standard, graduate, and extended repayment plans. These are not income-driven repayment plans. All right. The standard plan is basically you pay a fixed amount each month until your loans are paid in full, and it will take 10 years. That is the plan. Also, that if you do not choose a repayment plan, that is the one that you are automatically enrolled in. All right, so it takes whatever your loan balance is and guarantees that it's paid off in 10 years. The graduated repayment is that you start off, your payments may start off lower, and then they will increase every 2 years. Your payment goes up. And the extended repayment, this can either be extended fixed repayment, which is 25 years, or extended graduated repayment, 25 years. All right. That's, you're paying that amount over time. The maximum time is 25 years. And you can only sign up for this repayment option if you have more than $30,000 in outstanding loans. So the monthly payment for the extended is lower, but you end up paying more in interest, whereas that's not always the case with standard and graduated. So now we talk about income-driven repayment plans. What is an income-driven repayment plan in general? That is basically that your payments are hopefully based off of what you are currently making, your family size, and other factors. So we're going to talk a little bit about them. The first one is income-based, which is IBR. This means that your maximum monthly payments will be 15% of your discretionary income. Discretionary income is not anything that you as a borrower have to figure out. There are calculators for that. It is based on income, family size, and the state of residence. You do need to submit annual documentation. That is going to be the case for any income-driven repayment plan. And then your payments change as your income changes. And the time you have is 20 years. You have to pay for 20 years if you're a new borrower after July 1st, 2014. If otherwise 25 years, then it would be just discharged, but that would count as taxable income. So I'm going to actually jump from income-based to, sorry, can you go back, Andrea? Thanks. Pay as you earn. So these are all pretty much around the same, right? So repay, pay as you earn. Pay is the max payment is 10% of your income, but that's only for new borrowers. I'm going to skip save because we have a whole other slide about the Save on a Valuable Education Plan. Then there's the income contingent plan, the ICR. That's 25 years based on adjusted gross, your AGI, your adjusted gross income, your family size, and the amount of direct loans that you have. Income sensitive, this is for Stafford and Family Federal Education Loan Plans, and that's based on your annual income, and you have 15 years for that. So again, for all those specifics, we go into more on a different webinar, but just know in general, the income-driven repayment plan is supposed to, you put your income in every year, you get a monthly payment based on that. All right, so I'm going to talk a little bit more specifically right now about SAVE because this has been in the news a lot lately. So Saving on a Valuable Education, this replaced the income-driven plan known as REPAY. So if you are currently in repayment and you were on REPAY, you are now on the SAVE plan. But this is a new repayment plan that was just launched by the Biden administration. This increases the income exemption to 225% of the poverty line, which means monthly payments should go down. There are the only eligible loans are direct subsidized or unsubsidized loans. It has to be a direct loan. Direct consolidation loans do count unless they are parent plus loans. Otherwise, they count. The monthly payment, this lowers the monthly payment by being 10% of your discretionary income. And again, it needs to be adjusted annually. For all these income-driven repayment plans, you will submit certification of your job and your income each year. And then any outstanding balance will be canceled if it's not repaid in 20 years if you're an undergrad or 25 years for graduate. So you may have seen this last piece has been in the news a lot, that as long as you're making your monthly payment, your loan balance is not going to grow due to unpaid interest. Basically, the federal government will then cover that unpaid interest piece. So as long as you make your monthly payments on time each month, your loan balance should not grow. Again, this is a new plan, so it's been in the news a lot. We want to make sure to highlight that. All right, so we've also talked about how in the very beginning and the myth and fact, you know, income-driven repayment plan may not be the best for everybody. So how do you find the best repayment strategy for you? First, you need to think about your personal information. So what type of job do you have? Do you have other income that factors into your total income on taxes, right? What kind of taxes, what do your taxes look like? How big is your family? You know, do you have savings goals? Do you have to pay more for health insurance, or how much is your home costing? All that type of stuff that you need to get a full picture of your finances. Then you also need to make sure you have the correct loan information. What type of loans do you have? That is key. And then you need to think about your repayment goal. So depending on people's individual circumstances, they may have different goals. So you may want to just pay off your loan as quickly as possible, and you are in a position to do that. So you want a little bit higher monthly payments. On the flip side, maybe you can't do that, and the thing you need the most right now is low monthly payments. Or maybe you care about paying the lowest total over time, so not that interest. So think about what is most important to you and what fits with your life. And then again, Andrew and I, we're going to keep mentioning this. We have the student loan webinar series, but particularly student loan update number 2, we talk specifically about understanding repayment plans and strategies. All right, so why income-driven repayment? It's talked about a lot. You do pay more over time with income-driven repayment. However, there are many benefits to it if you are unable to meet your monthly plan on that standard, and your monthly payment on that standard plan. So the one that they will automatically enroll you in, this one may have better benefits to make your monthly payments. So some reasons that you should consider this type of repayment plan: if you're struggling to make payments each month, it does cap payments at 10 to 20% of discretionary income. Again, that depends on which plan, the 10 to 20% you choose. It takes into account your household size, marital status on taxes, and your state residence. So it's more personalized to your individual circumstances. And this is key too. You may have heard a lot in the news, or may already know about the Public Service Loan Forgiveness Plan, known as PSLF. You must be in an income-driven repayment plan in order to qualify for that loan forgiveness program. And now I am going to turn it over back to Andrea to talk about loan consolidation and refinancing.
Thank you so much, Nikki. So I'm just going to talk about a few highlights. So if you're wondering what the difference between a direct consolidation loan and a refinance loan, here's a very high level kind of summary of the differences. So all federal loans are going to be eligible for a direct consolidation loan, but private loans are not going to be eligible for consolidation loans because they're federal loans. So if you have maybe a combination of federal and private, and you really want to get them all with one lender, you can look into private refinancing loans, but you will lose any eligibility for forgiveness, cancellation, or other federal repayment options and benefits. So it's something you really need to consider before you take the plunge. Refinancing is also going to be your only option if you want a lower interest rate. So, but it could be variable, and it is based on your credit. So you may not be eligible for a lower interest rate. You won't be able to lower your rate with a direct consolidation loan, but it will be a fixed rate, and it won't be more than 8.25%. It's typically a weighted average of the different federal loans that you have and their interest rates. Credit checks are required for both private refinance loans and consolidation loans. So that is something to keep in mind. If your goal is to save money every month, either option might work. But if your goal is to save money in the long run, you'll want to consider an option that does not extend your repayment period and lowers your interest rate. And then only direct consolidation loans are eligible for income-driven repayment plans, like Nikki was just talking about. And if you do decide to pull in that Perkins loan, if you got one from your school into the consolidation loan, you will lose any potential loan forgiveness options that is specific for Perkins loans. So that is something to keep in mind as well if you do want to pull Perkins in to a consolidation loan or a refinance loan. We actually did a deep dive on the differences between consolidation versus refinancing. We talked a lot about compound interest considerations in our student loan update number 3, which thankfully Suhassis shared in the chat. So check that out if you are interested in exploring refinancing or consolidation options, because we do a lot more explanation there. All right, so let's talk about qualifying for loan forgiveness. There are several types of loan forgiveness. There's cancellation, there's teacher loan forgiveness, public service loan forgiveness. And then with each of these, there are different lengths of time you need to make payments that that might be required for either cancellation, not consolidation, which I was just talking about, or loan forgiveness to be an option for you. So, and then there's law school loan repayment assistance. If you went to law school, there's this program that you can look into. And then National Health Service Corps. These are 2 types of loan forgiveness plans that target specific people entering certain fields. It's similar to the teacher loan forgiveness program in that way. And then there's also a total and permanent disability discharge option that forgives the balance of your loan. The American Rescue Plan Act that was passed in 2021 exempted federal student loan forgiveness of all types from federal taxation through 2025. So that covers some types of forgiveness that were historically subject to taxes on any amount forgiven, like cancellation, total and permanent disability discharge, but it's only through the end of next year. We don't know what after 2025, if any amount is forgiven, what that will look like for your taxes right now. So that's just something we wanted to make people aware of. And we have a bunch of other things in the chat if you are interested in learning more about those different forgiveness options. So I'm going to focus a little bit on public service loan forgiveness in a second, but if regardless of what you're doing, if you're seeking loan forgiveness, you want to know what you're eligible for based on your situation, like what kind of job you're going for, what kind of loans you had, how long you're going to maintain a career in a specific category, like being a teacher or a public servant or a lawyer, all those things. You also want to understand how to maximize forgiveness. We talked a lot about income-driven repayment, and all of these forgive the remaining balance after so many years of payments. So you need to be in an income-driven plan to take advantage of maximizing the amount that's going to be forgiven after X amount of years. You also want to keep track of your payment counts. Right now, they're doing a one-time only payment count adjustment. So from now on, you got to keep track of it yourself and make sure that your servicers are tracking your payment counts appropriately. And you also want to make sure you're submitting required paperwork annually or whenever there's a change in your situation, like maybe you get a new job or you move to a different state or you expand your family. You want to submit your required paperwork to make sure it's up to date whenever there's a change. All right, so public service loan forgiveness is a program that forgives the remaining balance on your direct loans. It's only direct loans after you have made 120 qualifying monthly payments. This means not late, and for the amount shown under a qualifying repayment plan while working full-time for a qualifying employer. This program was intended to encourage individuals to enter and continue to work in full-time public service jobs, so that they may qualify forgiveness of the remaining balance of the direct loans after they've made 10 years worth of qualifying payments. We talked specifically about public service loan forgiveness in another update, and we went over in a lot more detail everything. But one thing, if you're like, but what if I just want to know right now, will public service loan forgiveness work for me? So we made this little flow chart. You want to ask yourself, do you have direct loans, federal direct loans? Are you employed by a qualifying public service organization? For instance, the University of Illinois is, the state of Illinois is, right? So both Nikki and I, if we had direct loans, would qualify for public service loan forgiveness. Do you plan to stay in public service for the duration of your repayment, which is 10 years? Are you on a qualifying repayment plan, an income-driven repayment plan, ideally? Then public service loan forgiveness may be a good option for you. You also want to consider what your debt is, your family income, and what your career plans are. So I had all direct loans, but my loan amount was low, so I was able to expedite loan payoff. So even though I qualified working in public service, it didn't make sense to try to extend my payments because my income was too high to qualify based on the debt that I had. So in that case, it didn't work for me. So those are things that you need to consider when you're looking at public service loan forgiveness for yourself. All right, so you can check out public service loan forgiveness on our update number 7 webinar, which Suhas just put in the chat. So we go over a lot more details about what qualifies, what doesn't qualify, what to consider, how to make a plan, how to advocate for yourself. So check that out if you are interested. All right, so if you're applying for a public service loan forgiveness, you want to send in documents as soon as you begin repayment to make sure you qualify. So if you know you're graduating this semester, you have a job for being a teacher in the fall, start getting as much of that paperwork submitted as soon as you can. Get the employment verification form filled out, use the public service loan forgiveness tool to help you kind of get that all organized. Make sure that your employment certification form is sent in and at least once a year. Maybe you do it multiple times a year to ensure that your payments are counting towards forgiveness. Do not wait until that you've made 10 years of payments and then you realize that one of your jobs that you worked didn't actually qualify. It wasn't a 501c3, or even though you were doing similar work, it wasn't an organization that was covered. So just make sure that if this is something you want to do, that you are being proactive with it. All right, I am going to hand it over to Nikki to talk about making a plan.
Hello, I'm just going to answer this because I'm mid-answer in the chat right now, and it has to do with public service loan forgiveness. So I'm just going to quickly answer for anybody who's saying, the question was, what if you have one direct loan and you have a family federal education loan or FFEL loan? Do you have to consolidate that in order for public service loan forgiveness? The short answer is yes. If you want your total loan balance to be considered for public service loan forgiveness, you do need to consolidate your FFEL loan with your direct loan. We do have a whole podcast that should be coming out shortly about this. There is a deadline to do that, however, it's April 30th. So if you have a FFEL loan and direct loans, you have until April 30th to apply for consolidation to qualify you for income-driven repayment and public service loan forgiveness. That doesn't start your payment clock over. So that means you can consolidate them together and your payments, your past payments will count as well.
And Nikki, that's
Andrea, I don't know
April.
if you have...
I was just going to say that's
30th.
April 30th 2024. It's not an annual April
Yes.
30th deadline. It is a singular deadline. So by the end of this month, if that's what you want, you got to consolidate.
Yeah, and this is not a deadline that, like, you know, in the past with COVID payment pauses and things like that, it was, here's this deadline and then it got moved. This deadline will 99% not get moved. Like, if that is something that you are interested in, you need to do that and look into it by April 30th. You need to have that paperwork in. All right, so we are going to talk a little bit about how to deal with your student loan debt and how to make a plan to repay it, and really talk about some of the consequences and things that come. So what are some consequences of default? So your loan becomes delinquent immediately. The first day after you miss a payment, it is considered delinquent. Even if you just miss one monthly payment and you start making payments again, your loan account will remain delinquent until you repay the past due amount, or you make other arrangements such as deferment or forbearance, or changing your repayment plans. So what are the consequences of default? This can be very severe. Now, default is not the same thing as delinquent. We just wanted to highlight that even if you miss one payment, your loan is considered delinquent. And then if you continue to miss payments, you're in default. And this could be very severe. So first, your entire unpaid balance and interest is due immediately. It's, the fancy term is acceleration of your loan, because basically they're saying you've missed all these payments. We need everything right now.
And I just wanted to, sorry, I think something that when we were consolidating in this PowerPoint, we forgot to highlight is that you become delinquent when you miss a payment, but you go into default after you miss basically 9 months worth of payments. So this is a long time before you go into default. You have plenty of time to make alternative arrangements, but we're going to talk to you about the consequences of default because they are so severe. Don't wait 9 months.
Yes, don't wait 9 months. So, and I think there's, because you can't easily declare bankruptcy or anything like that, there's a false sense of maybe it's not that bad if I don't pay. So we just wanted to let you know that this is what happened. So if you go those 9 months without paying, your delinquent account goes into default. Your entire balance and interest is due immediately. You lose access to any federal student aid and loan benefits. So that means you cannot request deferment. You cannot request forbearance. You cannot pick your own repayment plan anymore. Also, your student loan default stays on your credit reports forever. It does not drop off like other things that may show up on your credit report. You default on your student loan payment. It stays on there forever. There is a program called loan rehabilitation, and then a student loan default can be removed from your credit history or your report, but it will stay on there if you consolidate it out of debt. So that's just something, again, credit reports are used for lots of different things. So just keep in mind that defaulting on a student loan shows up, stays on there, and you have to take significant actions to try to get it off. Also, your wages can be taken out of your paycheck to go directly to pay off your student loan debt. That also includes tax refunds are withheld, any sort of federal benefits withheld. So defaulting on your student loan has these very serious consequences. Also, depending, this isn't, some schools do this, some schools don't, but your school may actually hold your academic transcript. A lot of schools are not doing that currently, but It's not unheard of either that if you default on your student loan. So just we put these consequences into stress to that should be your last, to do everything you need to do before you get there. There is a special program called Fresh Start that was launched by the Biden administration. If you were in default before COVID, so your loan was in default, then COVID happened and the payment pause happened, you may be eligible for this special Fresh Start program in order to get that default resolved. Again, this is a program that's very specific to the situation that we were in about COVID and the payment pause. So this is not necessarily a permanent type of program, and it's very specialized and individualized. So there's a link there that talks about it. If this applies to you, make sure you go on and read through it before you start calling your servicer to see how you could become part of this program. All right, so deferment and forbearance. We are going to talk a little bit about this. We did also discuss these two things in detail in one of our other student loan webinars that will be linked. But deferment and forbearance are both tools that you can use for temporary monthly payment relief. You have to work directly with your servicer to see what those qualifications are. Your interest still accrues in both of these situations. And depending, if you defer for a month, if you put it in administrative forbearance, depending, your monthly payments could increase when repayment starts again to like cover those skipped payments. But again, you really need to talk to your servicer, and things like deferment and forbearance or default, a lot of this is personal and based off of personal finances and the situation you're in. So we just really urge you to call or submit forms or email to see what may help. All right, so how do you want to pay your repay your loans? You do need to think about, as I know Andrea mentioned this, what your career goals are. All right, so think about your career path. If public service loan forgiveness is for you, just remember it's a 10-year commitment. So you are going to want to make sure that you are in public. If you want your loans paid through that forgiveness program, you are committing yourself to 10 years. While you're in school, you could try to keep your debt lower than your first year salary. So think about it that way, right? Like, what's your intended salary for your career? How can I keep that lower? We also recommend that you start thinking and budgeting now to make the transition from being in school to repayment. That way it's not so much of a shock for you. Also, make sure you're factoring in things like cost of living. If you are going to school in Champaign, but then want to move to New York City, that's going to be very different, right? So just start thinking about that in general. Again, PSLF 10-year commitment, and be flexible. Things change. You may sit down and think you have a plan, but then you end up in a different career path or something changes. So just don't forget that income-driven repayment is an option always, and that deferment and forbearance is there as an option before you skip a payment. All right, so how can we make paying my loan faster? So here's just some tidbits that we recommend that helps. So first, limit what you spend while you're in school. that will reduce the initial cost of your loan and balance of the loan. So that's one strategy. Another is bi-weekly student loan payment. So you get a monthly payment, but maybe it's better, you're in a position to split it up, that given what days you're paid, right? Maybe it's easier to do half of your payment for the beginning half of the month, half of the payment at the end, whatever it might be. Make sure you sign up for ACH, or otherwise known as automatic payments. You get a 0.25% interest discount for federal loans by signing up for automatic payments. Every little bit helps. And then if you pay more than the minimum, then you can apply that additional amount directly to the principal of your loan, which should help lower it faster. And this could even be something like 1 month you can't. The next month you've got an extra $50 that you want to throw at it. That's fine. There's debt snowball or waterfall method, which we talk about in a lot of our budget resources that I know there are a bunch of links being dropped right now. And then this last one, this is not really in play anymore per se, but payments were suspended for a little bit. Some are still suspended for some people due to COVID-related instances or due to school. There was something with a servicer that it did. Some people in very specific circumstances may not be paying right now, or may not have to pay right now, and you may choose to keep paying on it in order to pay down that principal while they're suspended. So this is just a little graph that you could show so we could show you how, if you owed, this was, Andrea, I know you came up with this number. It's the national average,
so
median.
the national average, according to the loan simulator, was 26,946 for an undergraduate bachelor's degree. And I know that we're at the hour, so if you need to log off, that's fine. We are recording this and we'll send the recording to everyone that registered, but we have a few more slides to get through, so we're going to run over it today, and I'm sorry. But yeah, the 26,000 roughly was the national loan amount. I think the Illinois average for a bachelor degree is around 29,000 last I saw. And then I think for most U of I campuses, it's around 23 to 26.
So
yeah.
So using those statistics, Andrew kind of plugged it in to show us how the minimum monthly payment was $272 in this case. Let's say we could afford an extra $50 a month. You're going to save over $1,000 in interest. This says it was paid off by April 2032, but which is 2 years faster than if you just paid the minimum, because it says was February 2034. So this is all stuff that you could play around with on the loan simulator as well, if you find yourself in a situation where you may want to have a little bit more, or maybe it's something you get a tax return, you want to put more down on a month, etc., the loan simulator can show you how that works. So you do need to work with your loan servicer. Your loan servicer is the person that really does everything regarding your loan. So that's who you make your payments to. That's who you make request changes to anything, to your repayment plan. That's where you request deferment or forbearance. It's where you apply for student loan forgiveness or for loan cancellation. And that's also where, if you discharge your loans due to permanent disability, but your loan servicer is the one that you do all of these things with. So that is a very important, and I'm not going to lie, they could be frustrating to deal with, but that is the number one person that can help, or entity that can help you do all of these things. It's also important to note that many loan servicers have changed. People have stopped servicing. There were a bunch of loan transfers, a whole bunch of stops. So when you log into your student loan dashboard, you would actually be able to see right there on your student loan dashboard exactly who your federal student loan services are. They may all be with one servicer. You may have different, depending on the loan type, they may be managed by different people, whatever it might be. But you can find that information on your student loan dashboard. Just know it's your servicer is whoever you're actually paying. So, and another thing too that we want you to know is that you should know your rights in Illinois. Illinois does have a student loan bill of rights, and that's at the Division of Banking at IDFPR. We have a unit that's dedicated to a lot of different student loan issues. So a few things specifically to note: you don't have to pay for help on student loan issues. There are a ton of scams right now going on with student loans, a ton. I actually just got an email yesterday to my personal account from a scammer telling me that there's important information regarding my student loan account, but et cetera, et cetera. Like, don't click on any of that stuff. Don't, if they call you, ignore, like they need to the only person you need to be talking to is your servicer. No one should also be charging you for any help with your student loan. You can report bad student loan servicers to the CFPB. You could also report them. I actually had it in the chat to the Illinois Attorney General as well, which also gets to the Division of Banking. And you could also report those student loan debt relief scams to the Federal Trade Commission. So how to file a complaint. These are a list of all of those things. I forgot that we had put that on the slide, but yes, the Illinois Attorney General, CFPB, FTC, there's lots of different things. Make sure when you're filing a complaint, you explain the issue as thoroughly as possible. You're writing down as it's happening, particularly if you're calling, you have an issue with maybe your loan servicer. The more facts we have, the better. So, you know, what time you called, what day you called, did you get the name of the person that you spoke to, things like that. Any sort of documentation, and then submit it to the appropriate agency. All right, so then in summary, don't forget these 5 things, right? Know what you owe and know who you owe. Make sure you have a plan. Know your rights, and then leverage the tools that are available to you. These are some helpful sites, tools that you guys can use to look at. I know it's a shameless plug that we have been this whole time, but our student loan mini webinar series is very helpful and goes into a lot of different details on the topics we touched on today.
I agree with Nikki.
Next webinar. Okay, I was like,
I'm sorry, we hadn't discussed who was taking over wrapping up the rest of this. So this, again, the student loan update series, if anything was confusing here, it's because we tried to cram a lot of information in an hour, 10 minutes. And we have probably 8 different webinars that range in time in detail between 15 minutes per topic to an hour per topic. So definitely check those out if you are confused by this or something piqued your interest. Our next webinar is Money, Stress, and Bad Habits on Wednesday, May 1st with UIC Wellness. They are co-facilitating that webinar with us. You can also watch all of our previous webinars on YouTube, on the Student Money Management Center's YouTube. So you can check those out, as well as our student loan update series, which is in its own playlist. And you can stay in contact with all of us, all the collaborators. We will stick on for some questions if you do have any, but don't feel obligated to stay on. I know we ran about 6 minutes over, but hopefully we gave you a lot of really valuable information that you can take with you to manage your loans, make a plan, advocate for yourself. And if you do think of questions later, you can always email studentmoney@uillinois.edu and we can try our best to answer them. All right, I know there was a question earlier in the chat that was kind of specific that I thought Nikki might be good at discussing. We had someone that said she had some money from AmeriCorps that she was trying to get applied to her loans and it wasn't accepted. And she's not making payments right now. So the total amount is
Yeah.
gaining interest. Yeah.
So Kathy had also responded to her to report that to the CFPB, but I highly suggest actually, and I gave her the number and email, the complaint form, calling the Illinois Attorney General's office hotline. And just so you guys are aware, the Illinois Attorney General's hotline and complaint form also works in conjunction with IDFPR, the Division of Banking, which is where I came from. So that is where I would start with that personally. CFPB is great. They will definitely open up a case, but the Illinois Attorney General's hotline is a little bit easier, less waiting for answers.
And it's so any borrowers that live in Illinois have additional representation through Illinois State's attorney. And when Nikki was a regulator with IDFPR as well, some advocacy at the state level. So if you're in a different state, maybe you moved after you graduated or you're just joining from another state, you might want to check with your state advocacy representatives, like your state attorney general, if you don't live in Illinois.
Yes, most states now have either at the attorney general level or their financial regulator. There's usually in Illinois, the Illinois Attorney General and the Illinois Department of Financial and Professional Regulation. But other states also have those same type of entities that have been focusing on student loans as well.
All right. I didn't notice any other big questions in the chat. I wasn't following it very closely. Suhas, were there any questions that we didn't address in the content of the webinar? All right, it doesn't look like any were noticed. So thank you again for joining us. We really appreciate all the activity in the chat and participation in our polls. It makes it a lot easier for us to be interactive in a virtual space. So we really like all that engagement. We will get this captioned appropriately and up on our YouTube channel as soon as we can, and we will also email it to all the registrants. So thanks again. Have a fabulous rest of your day, and we hope that you feel empowered to better manage your student loans, regardless of where you are in the process.